blame the banks on the mortgages, and so the rating agencies were rating them. They said they're AA or AAA, but they, effectively weren't.
As CEO of JP Morgan Chase, Jamie Dimon has been sounding the alarm on potential risks in the mortgage market. But what exactly does this mean for homeowners, investors, and the broader economy, and could we be facing another financial crisis similar to what happened in 2008? Well, Jamie Dimon recently raised concerns about the private credit market, highlighting potential risks if this less regulated sector starts to show weaknesses. At a conference, Dimon warned that if problems arise in this opaque financial market, there could be serious consequences, comparing it to the mortgage market crisis of past years. The private credit market involves loans to private businesses from lenders that aren't traditional banks. This sector has grown quickly in recent years, offering higher returns compared to more standard investments like stocks. However, the risks involved aren't as well understood or regulated, according to observations by the International Monetary Fund in April. Dimon pointed out that while some players in this market are highly skilled and provide vital financial support to businesses that big banks might overlook, there are also risks. He expressed surprise at the ratings given to certain deals in this sector by rating agencies, suggesting that they may not accurately reflect the true risk involved. He pointed out that problems in financial markets often come from mistakes made by those who may not have the best intentions or practices. One of the potential issues Dimon highlighted is the increasing involvement of retail investors in private credit assets. These investments can be tricky because they often lack liquidity, meaning they can't easily be converted to cash, might not be valued accurately, and may not even have been thoroughly tested to see how they would hold up under tough economic conditions. Dimon worried that if retail investors face losses or find themselves unable to withdraw their funds when needed, it could lead to significant backlash. Retail clients tend to circle the block and call their senators and congressmen, he remarked, suggesting that public outcry could be substantial if such issues arise. He also illustrated his concern with a vivid scenario. What happens if a little old lady finds out she can't get her money back? Despite any disclosures made by the private credit industry, Dimon believes that retail investors, who are not adjusted to such liquidity risks, may react poorly to any financial losses or delays in accessing their investments. Interestingly, despite these concerns, JP Morgan Chase is planning to expand its presence in the private credit market. Reports indicate that the bank is looking to acquire a private credit firm and has set aside a substantial amount. That is $10 billion for direct lending in this sector. This caution about potential risks in the market, it shows the balance between recognizing risks and opportunities in financial markets, where institutions like JP Morgan seek to navigate and capitalize on evolving market conditions. While Dimon doesn't foresee these issues causing a widespread crisis like the Great Recession, he did emphasize the possibility of problems surfacing. His comments show the importance of rigorous risk assessment and transparency in financial markets, especially in areas experiencing rapid growth and regulatory evolution. The private credit market, where non-bank financial institutions like insurance companies and hedge funds lend directly to corporate borrowers, has experienced a significant resurgence in recent years. This growth has been fueled by factors such as increased regulatory scrutiny on banks, rising inflation, and higher interest rates, prompting traditional banks to reduce their lending activities. According to data from the IMF, assets and committed capital in the private credit sector have skyrocketed from about $500 billion a decade ago to $2.1 trillion last year. Looking ahead, Preqin's 2024 Global Report expects that assets under management in private credit could swell to $2.8 trillion by 2028. Despite these impressive figures, Jamie Dimon offered a balanced view of the sector. He acknowledged several advantages of private lending, including the flexibility for lenders to modify loans and establish reasonable terms that allow businesses quick access to capital. He has also expressed deep concerns about the private credit market, particularly regarding the lack of stress testing and transparency around valuations, often referred to as the marks. Speaking at a conference, Dimon questioned whether some private lenders are conducting sufficient research before issuing loans, noting that some loans in this sector lack credit ratings altogether. Another major issue Dimon highlighted is the impact of rising interest rates on the value of private loan portfolios. He emphasized that many investors may not fully grasp how higher interest rates can significantly devalue these assets over time. Do people really fully understand what I said about interest rates affecting what these things are worth today? Do they? He questioned. Looking ahead, he cautioned that when inevitable financial challenges arise in the private credit market, there could be widespread consequences. When the shit hits the fan, and it will be one day, we don't know when, there will be a lot of stranded borrowers, he predicted, showing the potential for severe disruptions if risks in the private credit sector are not managed effectively. Having led JP Morgan for over 18 years, Dimon is one of the longest-serving bank chiefs on Wall Street, making his eventual departure a subject of considerable interest and speculation in financial circles. During the recent Investor Day, Dimon mentioned key executives who could potentially succeed him as CEO, including Jennifer Piepsiak and Troy Roba, co-CEOs of the Commercial and Investment Bank, as well as Marianne Lake, CEO of Consumer and Community Banking, and Mary Erdas, CEO of Asset and Wealth Management. These leaders are viewed as strong candidates to take on the top role at the bank. Dimon also highlighted recent efforts by Wall Street banks to reclaim their position in corporate lending after facing competition from private equity and asset management firms in recent years. These banks have collectively raised billions of dollars to strengthen their lending capabilities in debt-backed deals. However, Dimon tempered this optimism with a cautionary note regarding net interest income, aka NII, which represents the difference between what the bank earns from loans and what it pays out on deposits. He warned that the current surge in NII is not sustainable over the long term. JP Morgan Chase expects its NII to reach $91 billion this year, excluding its markets division, showing the significant contribution of interest income to the bank's overall revenue. Now, Dimon's perspective shows the balance in financial markets between innovation and risk. While private credit serves a crucial role in funding businesses, its rapid growth and less transparent nature raise caution flags amongst industry leaders and financial watchdogs alike. Keeping an eye on how this sector evolves and ensuring adequate oversight could be crucial to preventing future financial instability. If you enjoyed this video, then don't forget to like, subscribe, and hit that notification bell so you never miss an update. Thanks for watching, and we'll see you next time.